Debt. Debt is a four-letter word, and like most four-letter words, it can either give us an enormous amount of pleasure if we treat it correctly, or it can cause us an enormous amount of pain. I mean, look at those figures that you've just seen on your screen there. According to the Economist debt clock, global debt now stands at a staggering, a mind-boggling $49 trillion US. So let's define debt and look at its history. Let's look at who uses debt and why they use debt: the individual, the corporate, the nations, the sovereigns. And finally, at the end, hopefully, with all our experts, with all our research, we'll find out what the solution is to this massive, massive problem of debt. I'm Lindsay Williams, and this is Debt, a global horror story. It's almost as if the world is at panic stations. It appears as if the Eurozone is on the point of collapse, and things don't look much better in the United States, and there are even hints that China could be the next superpower to get choked by debt. Perhaps we should have listened to what the bard himself said, William Shakespeare, in his play Hamlet. Thank you, Lungila. I've got the collective works of Shakespeare here, by the way. He wrote something that was actually very prophetic. If I can go now to, here we go. Hamlet, Act 1, Scene 3. And there's a character called Old Polonius. Now, his son is going over to Paris to further his education. And he's a bit of a hot-headed sort of character. And Old Polonius gave him the following sage advice. He said, "Neither a borrower nor a lender be, for loan oft loses both itself and friend, and borrowing dulls the edge of husbandry." More of that later on. This above all, to thine own self be true, and it must follow as the night the day. Thou canst not be false to any man. Now, that's Old English, of course, but what he's basically saying there, Old Polonius, is that you don't lend to your friends. In fact, in his eyes, you don't borrow from anybody and you don't lend to anybody, and you especially don't lend to your friends, because what happens is that if you default on the loan, then it causes problems. And if you sort of bring that forward to what's happening in Europe at the moment, that's exactly what's happened to places like Greece and Spain. They've borrowed and they've made themselves this extraordinarily ostentatious lifestyle. And in fact, during Shakespearean times, what a lot of so-called gentlemen did was they borrowed a lot of money, they gave up their husbandry at home, and they went off to London and led ostentatious lifestyles. It's a lesson for now, what we heard there from William Shakespeare. Okay, so we're on our way to the University of Cape Town now. We've been to the Greenpoint Stadium. We'll go to another iconic Cape Town landmark, University of Cape Town, to speak to Professor Mark Elaine. He was more than 20 years at the International Monetary Fund, and he is a professor now in applied macroeconomics at the UCT. So we're going to find out what he thinks about debt and what the solution is. Looking forward to this, although I must admit, it's almost like going to see the headmaster. I'm feeling slightly nervous.
Well, you know, if we want to go back in history, we probably have to go back to the days of the Bible. And I think it's quoted. I mean, there was, for a very long time, that you shouldn't lend with interest to your fellow brethren. And eventually during the Middle Ages, caused a lot of problems for the church because it was a grave sin, usury. And at the same time, it was also recognized that debt was very important, especially amongst the nobility. This is the way you financed the war. If you needed to have a war, you needed to go into debt and get some money, and you had to have some money lenders to loan you some money. But you know, the Romans, there's evidence that they had debt, and certainly the traditional story of money itself goes something like people put all their gold in the vault of the local goldsmith, and then he issued certificates like IOUs to people for that gold. And then people started trading the IOUs as money. Well, the IOUs were in fact like a debt. I owe you a certain amount of gold. And in fact, today, debt, some people would consider that paper currency is simply an IOU of the government. In the old days, it would be IOU gold or IOU silver. Today, it's not so clear what they owe you.
So Shakespeare, via his rather crusty character in Hamlet called Old Polonius, tells us neither to borrow nor lend money. But of course, normal society, in many people's eyes anyway, wouldn't be able to function without borrowing and without lending. I can't go out and buy a car just with cash. I haven't got that sort of money. And certainly there are very, very few people in the world that can go out and just buy a house. So we need people to lend money to us, and we need to borrow. Otherwise, the normal functions of our so-called daily lives would not be normal. And of course, it is a double-edged sword. Debt is a four-letter word, but can be used to create very many beautiful things. And just have a look at this now. I mean, look at this stadium here. It is, quite honestly, absolutely magnificent. We're in the middle of the Cape Town Stadium, which was built for the World Cup 2010. It cost £4.5 billion rand approximately. 80% of the money came from central government, and they borrowed that money. They borrowed it via bonds, whatever the function was. 20% came from the ratepayers and taxpayers of Cape Town. And it was a beautiful thing. It gave me a lot of pleasure, and it gave hundreds of thousands of people, millions of people during the World Cup an enormous amount of pleasure as well. But now the World Cup is over, of course, we're still paying for it. That's where debt can have a downside. And that is what the whole point of this program is about now, the efficient use of debt, the responsible use of debt. And if we don't use debt responsibly, it can come back and bite us. We're going to have an array of experts throughout the next hour or so, and funnily enough, one of them has just walked into the stadium now. It's Michael Power from Investec Asset Management. What are you doing here, Michael? Nice to see you.
Not Michael, Cristiano. Cristiano, please.
How did we get to that level?
Just through essentially making promises against the incomes of our children and our grandchildren. And we're essentially slowly enslaving them to the expectations that people today have as to what the state can do for them.
I don't understand. We're going to have a chat later on in greater detail about how it all came about. But 46 trillion, it just seems to have been conjured up from nowhere.
It's just an accumulation over a long period of time of everything from year on year just being swept forward, and compounding and rolling up. And the number has become enormous.
Here we are on the roof of the CNBC Africa building in Cape Town with a beautiful Table Mountain behind me. I can't look round because I'm incredibly afraid of heights. My knees have gone like noodles. Let's chat now to Satyajit Das, who's in the CNBC Sydney studio. Das is the author of Traders, Guns and Money, and also the excellent book Extreme Money.
Money is a claim on real goods and services. Now then the question is, do you have money? What happens if you don't have money? Well, somebody can give you the money, and in the modern world, that is debt, because somebody either creates the money or takes their store of money and gives it to you to enable you, theoretically, to buy those goods and services. And all you do on the other side is basically promise that you're going to pay back that amount of money together with something we call interest, which is really the fee or the cost of you actually receiving the benefit of that money today. And at the heart of this whole relationship is this idea, which comes from the Latin credere, which is the idea of credit and trust as synonymous. I trust you if I lend you my money, that you're going to pay it back in due course to me.
We're sort of a little bit obsessed now with the debt problems in Europe, but when I was working with the IMF during the 80s and 90s, there were huge debt problems in Africa and Latin America amongst developing countries. And people at that time thought this was something dramatic. But in fact, the history of debt goes back literally centuries. We've been seeing these sort of debts. In fact, during the 1800s, there were high proportions of countries that defaulted. There's stories here that the French government defaulted something like 13 times in the last 2 centuries. And Greece also has a bit of a long history of defaults as well during previous centuries.
The problem in the world is not debt. It is the fact that we took on more debt than was reasonable, and we missed the fundamental connection, which is that we need to be able to pay it back. So whatever we buy with that debt produces income or has and retains value. And we forgot that. And to some extent, also underlying that, which is implicit in all debt schemes, is the idea of what is loosely called a Ponzi scheme after Charles Ponzi. Because essentially what happened in the world is people started to borrow huge sums of money. And the real game became that I took the money and bought something because I always assumed somebody later on would buy that from me for a larger sum because they would be able to use that asset to borrow more money.
During the 1980s, a lot of African countries and Latin American countries started having big debt problems. It came right after the rise in oil prices and the commodity boom during the 70s. And the oil started costing more money. They started recycling all those petrodollars to make loans to governments. And sometime during the 80s, we started to see the beginning of these loan defaults, which were largely private banks who had been recycling and giving loans to many countries who looked with the commodity boom looked to be very profitable. We thought this, the boom from the 70s was going to continue forever.
Here we are now at Investment Solutions, as you can see. We're trying to find the solution to debt. We're going to talk to the Chief Strategist and Economist at Investment Solutions, Chris Hart. Let's go and find him.
Certainly, the beginning of the 80s seems to be a time when debt started to go exponential. One can probably trace it back right to the beginning of the 70s, when the US finally went off the gold standard or whatever. But at the end of the day, debt is going exponential at the moment. The growth is exponential and it's become unpayable. And so the question is, how does it get resolved? But you can plot any country's money supply data, for instance, and you'll see that exponential nature. And I think what has happened is that you've got a credit-based system which depends on consumption, and you've got credit driving consumption as your basis of the growth model. And that is now proven to get to its unsustainable point. In other words, we've got what you call a systemic Ponzi scheme, where the system needs more debt to sort out the debt that's already been incurred.
People encouraged people to lend to other people, and they brought forward all their consumption. So instead of waiting for 5 years to buy a car, we bought it today. And that's fantastic because it makes the economy grow, provided what you're buying with that can pay back the debt. And we forgot that. And there's also another essential link between debt and growth. If you're relying on debt to grow the economy and create greater prosperity, you need more and more debt. And so under the system that we created, at a certain point in time, the actual sort of pyramid of debt became too much and it just collapsed on itself.
The inflation of the 70s effectively ate into people's ability to keep up their standards of living, and so your consumer society effectively started to incur debt to compensate for effectively salaries that weren't being made. So you had household debt escalating, and then you also had in the corporate sector, the whole thing about lazy balance sheets. You've got to get your balance sheet to work, and so you bring on debt to actually improve your return on equity and that, but it doesn't increase the risks. And it's not really in the good times that you see this. This is when the bad times actually occur.
And certainly when you look at sort of, let's say, the European debt crisis, there is a problem of too much debt still being around. But it really has become a problem, let's say, since the 2007-2008 crisis. But leading up to that, we had an unprecedented and very long phase of abundant liquidity, low interest rates, which obviously helped to build up this bubble. And in the end, you had, on all fronts, in many countries, household debt going up, we had government debt going up, and obviously banks, as we are going through the credit cycle, banks becoming more vulnerable. In the 90s, when we had the beginning of the sort of abundant liquidity and sort of prolonged period of low interest rates, that it takes a time to build up. And like always in a cycle, and it takes a while, and at some point you reach that kind of tipping point But we always had countries, for instance, governments that were highly leveraged. Take Italy, for instance, take Greece. It took some time. We had to reach this tipping point where markets also lost confidence then, and then from then on you have a downward spiral developing.
Well, the point is that the expansion of debt is busy fueling the markets and producing an underpin. The systemic instability comes when the ability to absorb that debt is starting to level off, and that's why you're getting this disquiet around, and people are actually exceptionally worried because who's going to shoulder the next, how can you say, escalation of debt to try and resolve it. You're now getting the situation where growth is struggling, the debts are escalating, and when you've got a debt to GDP or a debt to economic activity problem, and the economic activity is being constrained by that debt, and the debt is expanding, your debt problems just escalate so much more.
Stay with us. After the break, my guests and I look into the state of household debt.